studying your last two. I swim med when they turned in. The staring down to mute. And can learn the pole that sunk he died.
When an incorporated business owner decides to pay themselves a salary, they are no longer acting only as the owner of the company. They are also acting as an employee. This is an important distinction because the salary is paid for the work they perform in the business, not simply because they own shares in the corporation. An owner-manager, therefore, has two separate roles. As a shareholder, they own the corporation. As an employee, they work for the corporation and earn employment income. Even though it's the same individual, these two roles are treated differently under Canada's tax rules. When salary is chosen as the method of compensation, the corporation must treat the owner just like any other employee. The salary is processed through payroll. A T4 slip is issued at the end of the year, and all required payroll deductions and remittances must be handled according to CRA rules. One of the biggest advantages of paying salary is its transparency. Every payment is supported by payroll records, reported on a T4 slip, and matched by the CRA through its payroll reporting system. Because of this, salary is generally considered one of the safest and most compliant ways to compensate an owner-manager. The overall payroll process is quite straightforward. The owner is added to the payroll system. The salary is paid. Payroll deductions are calculated. Those deductions are remitted to the CRA. And finally, a T4 slip is prepared at the end of the year. Each step creates a clear record of how the owner was compensated. The key point to remember is that owning 100% of a corporation does not mean you can ignore payroll rules. Once compensation is classified as salary, the corporation must follow the same payroll requirements that apply to every other employer in Canada. That's why salary remains one of the most reliable and professionally accepted methods of compensating an owner-manager. When an owner-manager decides to take a salary from the corporation, the payment cannot simply be transferred from the company's bank account. Instead, it must go through the same payroll system that every employer in Canada uses for its employees. The process begins by adding the owner to the corporation's payroll. Even if the owner controls 100% of the company, they are still treated as an employee for payroll purposes. The corporation must determine the salary amount and decide how often payroll will be processed, whether that's weekly, bi-weekly, semi-monthly, or monthly. Many businesses use payroll software to make this process faster and more accurate. Once the salary is determined, the next step is to calculate the required payroll deductions. These usually include federal and provincial income tax, as well as Canada Pension Plan, or CPP, contributions. In most cases, owner-managers are exempt from employment insurance premiums, so EI deductions generally do not apply. After these deductions have been calculated, the owner receives their net salary. This is the amount that remains after all required deductions have been withheld, and it is typically paid by direct deposit, electronic transfer, or corporate check. The corporation must then remit the deducted amounts to the Canada Revenue Agency. These remittances include the income tax withheld from the employee's salary, the employee's CPP contribution, and the employer's matching CPP contribution. For most small businesses, these payroll remittances are due by the 15th day of the following month. Meeting this deadline is extremely important because payroll deductions are considered trust funds that the corporation holds on behalf of the government. Finally, at the end of the calendar year, the corporation prepares a T4 slip for the owner-manager and files a copy with the CRA. The T4 summarizes the total salary paid and all payroll deductions for the year, and it must generally be issued by the end of February. Although this process may seem administrative, Every step plays an important role in keeping the corporation compliant with CRA requirements. Proper payroll reporting not only helps avoid penalties and interest, but also ensures that the owner's employment income is correctly reported for both the corporate and personal tax returns. When planning how to compensate an owner-manager, salary offers several important advantages beyond simply providing income. Although it requires payroll administration and ongoing CRA reporting, many business owners choose salary because of the long-term financial benefits it provides. One of the biggest advantages is that salary is a deductible expense for the corporation. Since it is treated as a business expense, it reduces the corporation's taxable income and can lower the amount of corporate tax the business has to pay. At the same time, the salary becomes employment income for the owner and is reported on their personal tax return. Salary also plays an important role in retirement planning. Because it is considered earned income, it creates RRSP contribution room, allowing the owner to build tax-deferred retirement savings. In addition, salary requires Canada Pension Plan, or CPP, contributions. While these contributions increase payroll costs today, they help the owner qualify for future CPP retirement, disability, and survivor benefits. Another reason many accountants recommend salary is its transparency. Payroll records, payroll remittances, and T4 slips create a complete audit trail that makes it easy for the CRA to verify the compensation paid to the owner. This makes salary one of the safest and most compliant methods of owner-manager compensation. Of course, proper payroll administration is essential. Tax preparers should always verify that the corporation has a CRA payroll account, that payroll deductions have been calculated correctly, that remittances have been made on time, and that T4 slips have been prepared and filed accurately. Good payroll records not only satisfy CRA requirements, but also help avoid unnecessary penalties and interest. It's also important to avoid common payroll mistakes: taking money from the corporation without processing it through payroll, missing payroll remittance deadlines, making incorrect CPP calculations, or filing T4 slips late are all common errors that can result in CRA reassessments, penalties, and additional compliance issues. The key takeaway is that salary is much more than a way of paying an owner. It reduces the corporation's taxable income, supports long-term retirement planning through RRSPs and CPP, and provides a clear, well-documented compensation method that helps both the corporation and the owner remain fully compliant with Canadian tax laws.